Well, there are growing worries about flight cancellations at Westjet with a looming strike possibility. The airline expecting about 25 cancellations between today and tomorrow, which would impact hundreds of passengers. Now, the airline's CEO says the union at the center of this squabble is creating maximum damage for Canadians.
In case the strike is actually going to happen, we will keep a base network flying, but it will be substantially reduced. We don't want any flights to be cancelled. We want to serve Canadians the best way we can. It's the union AMFA that has been acting very unreasonably for a long time now already, that are now doing this in order to create maximum damage for Canadians.
Back now, Christine Tan of SLGI Asset Management. And, you know, when we think about the economy and we think about inflation, it's probably not a surprise that a lot of workforces across the country, they're paying more. They want to be paid what they feel is a fair wage. We've heard about a lot of labor disruptions, certainly over the last year and a half. What have you made of this Westjet situation?
It's a difficult situation for the company. We certainly understand. I wouldn't say we don't take a side, but we see both sides of the argument. As you said, inflation's high, so workers are basically saying we need to keep up with inflation in terms of our wages. It's a tricky situation for all airlines because, ironically, you wouldn't know this to hear news like this coming out of Southwest or WestJet, but IATA actually says 2024 is a record year. So whether you look at revenues, profits, ROIC, it's a record year. The problem is cost of capital.
Return on investment.
Return on invested capital, that's right. Yeah. The problem is cost of capital has gone up because interest rates are so high. And as you said, you know, cost of labor has been going up. So as top line's gone up, you've seen costs and wages go up as well. What the airlines are kind of trying to manage, I guess, in the case of WestJet, is once wages go up, it becomes a fixed cost. You can't really bring it back down if your top line revenues are softer. So they are in that difficult position. But again, we also understand why the engineers are asking for what they're asking. So it's a challenging situation, both sides.
And then I think just given the way the economy is rolling along here, there's a lot of people who are hopeful that interest rates do come down at some point, that the inflation story does quiet down. And I think that's something that investors have to think about, not just in terms of what happens in the stock market, which we talked about last segment, but also in the fixed income world. We've increasingly heard a lot of people say maybe this is the time to start building a notable position in government bonds if rate policy is changing. How is your team at SLGI thinking about fixed income right now?
So we like bonds. It is starting to behave a little bit more, I'll say it doesn't move quite in line with the equity markets in the last little while. So you are starting to see a little bit of that, call it hedging or negative correlation creep back in. In terms of what our underlying managers are doing, they're still being pretty cautious. You'll hear that term a lot from our team, cautious. So where there's exposure to credit, the teams pretty much focus on the upper end. So in a high yield portfolio, they like double Bs. They actually have investment grade exposure as well. That's how cautious they are. They feel they're not being compensated for the triple Cs and below type credit. On the fixed income side, more the govies or government bonds, they are neutral duration. So kind of recognizing that a couple of years ago, they were underweight duration with the view that rates were going up.
Yep.
And so you don't want to have shorter exposure or shorter bond exposure. Now they're neutral with the view that rates are going to slowly start to normalize. But I think it's important to really think about how slow this normalization is going to be. So we've heard it from Governor Macklem, we've heard it from Chair Powell and a number of other Fed governors as well. Yeah. It's going to be very slow because inflation's not falling off a cliff, which means rates are not going to come down very quickly. The other thing that's been clear from the Bank of Canada is we're not going back to the pre-COVID lows. So there's going to be a sort of a new level of rates when they stabilize. So that's, again, something to think about when you're an investor, that you're not necessarily, don't have to worry about bonds going back to near zero again.
Maybe like a staircase.
Exactly.
But not a big staircase.
Exactly.
Or something like that.
Exactly.
Yeah.
That's
right.